Now, what if I told you that you could buy an investment property with as little as 15% down payment? That's right. Now, there is a niche product available on the market that allows real estate investors to get into an investment property with less capital. There are a few catches that you should know about. So today I'm breaking down exactly how the 15% down DSCR purchase loan works, as well as an 85% loan to value rate and term refinance. We're going to talk about who qualifies, what it costs, and whether it's a good option for what your investment strategies are. So first, let's do a DSCR refresh if you're new here. Hey gang, if you really like these videos, please like and please subscribe. It would mean the world to me. I'd be honored to have you along for this ride. And my pledge to you is to keep putting out content to enrich your real estate investment strategies, your wealth creation goals, and plug the gaps in your mortgage financing education. All right, so for anyone new here, DSCR loans. Now, DSCR stands for Debt Service Coverage Ratio. And these loans are strictly for investment properties only. And the way that they're approved is it's based off of the rental income that the property generates or is expected to generate, and it has nothing to do with your personal income. Now, the formula, pretty simple. The DSCR ratio is made up of the expected monthly rent or the current monthly rent divided by all of your monthly mortgage obligations. Now, that includes principal, interest for your mortgage. It includes taxes and insurance, and where applicable, it includes HOA fees. Now, if you get your DSCR ratio at 1.0 or higher, generally across the board, that's a green light. That means you're approved. And if that property is able to cover its own expenses, this is exactly how you qualify. Now, what makes this 15% down DSCR purchase loan unique? Well, most DSCR loans require 20% down. And in some cases where there's more of a commercial use or it's a multi-unit property, sometimes that requirement goes from 20% to 25% down. So this is one of the unique factors with this 15% down program. Now, this also applies to the rate and term refinance. Now, quick refresh on rate and term refinances versus cash out refinances. So rate term refinances include at closing, you're paying off all of the liens. This is usually one loan, so one lien, or any additional liens that were secured at the time of purchase, meaning whatever the loans are that you used at closing on that property to purchase it, that's what would be considered a rate and term refinance. You're paying off the loans that you got at the time of purchase. Now, for example, if you got, let's say, a $200,000 loan at purchase, but then you brought in a private partner to come in with maybe $50,000 in rehab money, and they came in after the fact, but they lien the property to make sure that they're going to get paid back at closing, whatever they're owed, plus whatever profitability you're building in for them. That would not be considered a rate and term refinance if you're paying off the 200 and you're paying off the 50. That would be considered a cash out refinance. Paying off student loans at closing on a refinance, right? That would be considered cash out. Let's say you're going to pay off any credit cards, or maybe you're going to pay off an installment loan or a car loan or anything else that you want to pay off at closing. That would be considered a cash out if it didn't have to do with the purchase of the property. And additionally, if you're going to get back quite a bit of money at closing, and usually that number is over $2,000 cash back at closing, that's also considered a cash out refinance. So it's important to make this distinction because a rate and term refinance oftentimes is a little bit more competitive on interest rate and costs than a cash out refinance because the risk modifier is a little less for a rate and term. And additionally, a cash out refinance, you're going to be limited to 75% for most cases, and in some cases, you can get up to 80% on a cash out refinance. With rate and term, we're at 85%. Other items that make this type of product unique is this is available for first-time investors. So you don't have to have a wealth of experience in the space of investments to get a 15% down DSCR loan option. Now, the one hitch is you cannot be a first-time home buyer or home owner in this case, okay? So most often you're gonna need to show proof that you have a primary residence. And if you don't have a primary residence, there's some exceptions that are made for a lease. So if you have a lease in place for where you're currently residing, or if you currently own a property and that's your primary, then you're gonna be in good shape. Now, while this is a powerful way to preserve cash, let's talk about a few more details on this 15% DSCR loan. So who qualifies for this niche product? Here's a few bullets. Now, you're gonna need a 720 or higher FICO score. Now, if you have a FICO score that's less than 720, say it's 701, or maybe you're in the 680, 690 range, there may be some exceptions made. the truth is we have a handful of lenders that offer this product. So, and some of those guidelines are a little bit different from lender to lender. So definitely check with your lending resource to make sure they should have a product for you in that 700 to 720 range. Once you're below 720, it gets really hard to find this product out there. They want to make sure that that FICO score is strong enough because of the extra amount of financing that you're getting. Now, the minimum ratio here, you definitely want to be over 1, but a lot of the 15% down lenders require even a higher ratio. And all that means is you have to show more cash flow coming in on that property. So the numbers there, it could be 1.1 on the ratio or even 1.2. Some cases I even seen 1.25 on the ratio. If you think about this in terms of what the payment figure is, if you have a mortgage payment of, let's say, $2,000 per month. So if you need to hit 1.1 on your ratio, that would mean that we need to show market rent in excess of $2,200 per month or more. That would be 1.1. Now, if we're looking for 1.2, you can probably do the math here, but if you have a $2,000 payment that you're expected to make on this new mortgage, well, you need to have that monthly rent coming in at about $2,400 or higher. 1.25, $2,500 or higher, given a $2,000 monthly mortgage payment. Now, what types of homes can you use this for? Well, you can use it for single family homes, right? This is not applied to condominiums. This does not apply to manufactured homes. And oftentimes you're going to find it more difficult to find a product like this for anything that's 2 to 4 units or more. The criteria for lending is a little bit different, slightly different risk profile. And while I would never say that this 15% down DSCR product is not out there, if you have a 2 to 4 unit or even a 5 or more unit multifamily, I would definitely check with your lending resource on that. These products change pretty regularly. The guidelines and the requirements also change regularly, so definitely tap into your lending resource for more details. Now, this is also available for long-term rental properties only. As of right now, I'm not aware of a short-term rental program that exists where they will allow a 15% down option for a DSCR loan. But like I said, these things change all the time, so definitely check with your lending resource. Now, the types of borrowers this applies to, you can be a personal borrower, meaning you can close, invest in an LLC, or you can close, invest personally. Now, who are these products for? What is the borrower profile? Well, you have to be a US citizen. So right now, there are some exceptions made depending on how your LLC is set up. So for example, I have a client I work with regularly who is a foreign national, and he invests heavily in the States. So because of that, he works together with a project manager here in the States. They formed an LLC together, and the foreign national does not have a credit score. So this would be a very hard product for him to get on his own. He would likely be looking at private funds or a private lending channel that would likely cost more on the rate or perhaps more costs for the loan to get that done. But because he has a partner that has a credit score of 770, the partner in the LLC is the one that is the credit, basically he has the personal guarantee. So he's the one that is guaranteeing the note. He's aware that this product and this loan trade line is going to appear on his credit after closing. And that is the best way to do that if you have individuals in an LLC that either may not have a credit score or they may not be US citizens. Now, as far as the loan product itself, these are available as 30-year fixed loans only. They do not offer 40-year loans, and they don't have a interest-only option for either 30-year or 40-year. So you're looking at a 30-year fixed for a 15% DSCR purchase loan. How much in reserves do I need? Well, generally you're gonna need about 6 months of reserves, okay? And all reserves is if you hear a 6-month reserve minimum or a 12-month reserve minimum, all you're thinking about here is how many months of the payment that you're expected to pay do you have in reserve? So do you have in a checking account, in a savings account, in a CD, 401ks and IRAs and other sorts of retirement accounts are also able to be used for your reserve requirements. So in our example, if your mortgage payment is going to end up being $2,000 a month, if you need 6 months of reserves, we have to show $12,000 somewhere in various accounts that are in the borrower's names. Now, another requirement that really hasn't been that common over the past few years due to where the market's gone is there could be a modifier for a declining market. So if you're in a declining market where it's clear and evident that the prices have started to go down, and there's not a whole lot of those markets out there right now, who knows what's going to happen in the next few months or few years, but If you're in a declining market and you're trying to get a 15% down DSCR loan, you might have more problems with that. Now, when would this 15% down strategy be worth it? Well, one of the main goals for investors would be to preserve as much capital as possible. So whenever you can gain extra leverage, do so. It's going to keep more capital in your accounts. You're going to be able to then go out and buy more properties or rehab more properties. You're just going to have more liquidity on hand. So this loan can make a lot of sense if you've got a strong credit profile. And while experience doesn't matter, experience can only help. So if you've done, let's say, 3 different purchase loans, or you have 3 properties in your portfolio over the last usually 2 to 3 years, that's considered experienced. So in that event, you're going to get premium pricing where a first-time investor where this is their first purchase loan ever for a DSCR, they might experience a little bit higher interest rate, maybe a little bit more in cost because of that first-time investor designation. This loan makes a lot of sense if you've got a solid cash flowing property. I mean, if you're one of those investors that's able to go out there and find deeply discounted properties, finding a 15% down DSCR option might be really easy for you to do. And markets that come to mind specifically, a lot of my investors that work in the Midwest. So we're talking about markets in Indiana, Ohio, maybe Kentucky, Tennessee, the Carolinas, anywhere in that Southeast, Alabama, Arkansas, Louisiana, Michigan would be a good one, Wisconsin, Minnesota. A lot of those markets, the average price points are a little bit lower than in some of the more major metropolitan areas around the country. And in strong, dense areas, there's always going to be a demand for rents. There's always going to be a demand for rental property. So sometimes you can find a sweet, sweet deal. It doesn't have to be drastically discounted, but as long as the cash flow is there, this would be a great option for that scenario. The goal is to preserve as much capital as possible so you can continue to work on other projects. So while you're taking on more leverage by getting into this 15% down DSCR loan, if the numbers make sense and the reserves are solid and your borrower profile with credit and the types of borrowers in the LLC or the types of borrowers that are investing personally are strong, this could be a really smart move to scale faster. Now, here's a few things to watch out for. These are some of the limitations involved with a 15% down DSCR loan. And I'll be honest, this type of loan product is not for everyone. So here's a few things to watch out for. Number 1, the rates are typically going to be higher than a standard 20% down DSCR loan. Now that just plain makes sense. If the lender is experiencing more risk by lending you 85% of the purchase versus 80%, they're probably going to modify the terms a bit to account for that risk. Now you probably heard this throughout the video, but the guidelines are a bit stricter for the 15% down option versus a 20% or even 25% down. Things like your credit score, the borrower profile overall, who's in the LLC or who is the individual that's closing on this property personally. The reserve requirements are another example, and the types of properties that you can buy with this are also a little bit limited. The other thing, mentioning the Midwest, the inventory in your market might be a little bit limited, right? In terms of what can cash flow up to that 1.1 or 1.2, even 1.25 DSCR ratio. So we really need to make sure you have a good chunk of cash flow coming in. That kind of limits your inventory pool. The other thing to know about with the 15% down option, similar to the other options at 20% down, with DSCRs, there are prepayment penalties that are a factor here. So the longer you're going to hold this property, the cheaper that loan's going to be, because you can agree to a longer prepayment penalty term, let's say 3 years or even 5 years, to get your rate the lowest that you can get, right? If you're only going to hold this property for maybe a year or two, and then maybe you're looking to sell it or maybe exit that property, or you just want some flexibility to sell if you want to or need to, then you might see a higher rate or maybe a higher cost with the rate that you're getting because of those prepayment penalties. Now, overall, you're going to want to work with somebody that has done these before for themselves, would be a bonus, but also somebody that's done these for clients a handful of times, right? So getting the right strategy in place for what your goals are is one of the most important things that I discuss with my clients when we go through an initial loan consult. And we can definitely sit down and compare other financing options, even that 20% down option versus a 15% down option, just to see, are we going to fall into that 15% down category with the rents being what they are, with your credit score, with your profile, maybe with what the market's doing with interest rates, because they bounce around a little bit. So it's helpful to have that comparison in play And that's something you should definitely be getting from your loan advisor here. Now, if you're wondering if the deal that you have on the table right now, that you're reviewing right now, would fit for a 15% down DSCR purchase loan, let's talk about it. We can run the numbers together. All you gotta do is hit that link in the description below, book a call through my Calendly, and we'll go through the options. We'll go through the property profile itself. We'll come up with a good idea on what the ARV or the as-is value might be on that property, so we can do some of the numbers and the math behind what it would look like. We can compare the rates and the cost, go through different programs there, talk about prepayment penalties and your borrower profile to see what would fit, what would make sense. And it's something I love doing. Hey guys, thanks so much for watching. Really appreciate you tuning in. If this video helped you out, please click the like button, please subscribe, and stay tuned. I post weekly videos to help home buyers, to help realtors, and to help investors, experienced and first timers, get a good feel for what your financing would look like. My goal is to help you finance smarter and to help you scale faster. I want you to win. Thanks so much, and I'll see you in the next video. So those are just a few of the things that caused the closing costs to be.